let's go to the first question, which really is what could turn this, I think, very, very good state of the market, this bull market, into a bear market. And let's start with Karen. Trade tariffs, is that what you're really worrying about right now?
Well, I think to square the circle of why risk markets have done so well, but the core government bond markets have done so well also, I mean, it's been across the board. I think the way the market's interpreting the outlook at the moment is to say that the trade war probably won't escalate further. However, even if it were to, the Fed are going to pick up the pieces.
Yeah.
So the Fed are going to be aggressive, preemptive, doing everything it can to keep the US economy on the road. And obviously it's under a lot of political pressure to do so.
I mean, I worry that there's a bigger shift going on from, if you say the recent recovery out of the, global financial crisis and recent economic growth, as well as low inflation, has been driven by globalization. I worry you're starting to see a shift towards protectionism. And longer term, I think that's going to dampen the new normal of growth.
Right.
And there's also going to be winners and losers in certain countries, sectors, economies, and you're seeing that both through trade and tariffs, but you're also seeing it through the political system as well.
The headline numbers didn't change very much in terms of global growth for 2019 and 2020, but the big message was a shift in risks, and the downside risks to the global macro outlook are much more elevated now. I think the point about investment is very important. US business investment grew, I think, 7% in 2018. First quarter of this year, it was down to 2% annualized. And so the impact of this trade standoff, escalating trade war, is really starting to feed through into business investment decisions.
Last year taught me, as you know, I've been forecasting Europe for 20 years. And last year was a sort of real revelation moment for me, because we've always had this expression, when the US sneezes, the rest of the world catches a cold. And that was one of our nice mantras. I think last year we discovered quite how gravely the global system has changed. And now when China sneezes, the rest of the world catches a cold. Because last year the US was booming.
One other point here is the shift in credit quality. I'm looking at it from a sovereign perspective, but if you look at the distribution of ratings across the sovereign credit curve, the proportion now in the single B category is higher than it's ever been, and that's a combination of some of the newer frontier markets coming to market for the first time, but it's also a consequence of some downgrades from double B. So you've got elevated levels of debt across the piece, 250 trillion global debt compared to 150 pre-financial crisis. And the bigger proportion of that now is at the low end of the credit spectrum.
I'll challenge the idea that quantitative easing is necessarily going to be less effective, because I do think that the appetite at the political and the population level for austerity is gone. And I think with these low interest rates, we're going to see governments across the political spectrum more willing to tax less and spend more, take advantage of these low interest rates.
Does our panel think that a change in UK Prime Minister will mean a change in attitude towards renegotiating the withdrawal agreement among European leaders and the Commission?
I think, if anything, it's likely to harden the European resolve against renegotiation, particularly if the probable candidate wins.
I looked at Greece, Tsipras, and it was the end of the world. In the end, you go to power and you have to be reasonable.
Yeah.
And so whoever wins in the coming days, weeks, at some stage you need to steer your country out of trouble. So yes, we believe 25% is a current probability for hard Brexit, but it would damage everybody. So you can do negotiating bias, saying, well, if I'm the Prime Minister, I would do this, I would do that. So, I would not pay, blah, blah, blah. But at the end of it, when you talk real, let's see.
I said internally, and sometimes on speaker forums like this as well, if we go back to the year 2000, like the whole millennium bug, everybody was so scared about that one. Now we talk for ages about the Brexit. Like, isn't it priced in a bit here and there with some bandwidth? Or are we going towards that cliff? It's just like a question to spice it a bit here.
Yep.
I I think
Tony.
I think the important thing to remember on no deal is that no deal is not an end state. You know, the first thing that happens if there's no deal, if we did crash out on the 31st of October, what's the first thing that happens on Monday morning? We're on the phone to Brussels trying to negotiate some kind of bare bones agreements to keep aeroplanes in the sky, to keep vital goods and services being imported and exported. So no deal isn't the end. It's just a staging post into a much more difficult scenario.